The concept of Mensa or a roll-up brand of various different companies is not exactly new. I was reading about this company called Madura Fashion and Lifestyle, which bought brands like Louis Philippe, Alan Solly, Peter England, etc. And this also exists across the world. There's this billion-dollar publicly traded company in the UK called the Hut Group or THG, which also does the exact same thing. What is interesting about Mensa though?
So let's bring this back to valuation then, especially because we started this with the Thrasio conversation. Do you think Mensa is worth the valuation that it commands, and how big do you think it could be? I guess that's the more interesting question to ask.
What is Priyashi, a women's jewelry brand, My Fitness, a protein company that specializes in peanut butter, and Dennis Lingo, a men's fast fashion brand, have in common? They're all a part of the portfolio for Mensa Brands, a company that is in the business of acquiring and growing brands. Welcome to Weekend Entrepreneurs, where our mission is to help create more entrepreneurs in India. Today, we're going to be talking about how Mensa as a company works and talk through opportunities that could exist for entrepreneurs out there.
Great. So Rohit, why don't you give me a highlight reel of Mensa, the company, and what it does?
Yeah. So, if you look at traditional venture capital firms, they exchange money or capital for a certain percentage of the business. In most cases, they expect the founders to run and scale the business. And oftentimes, when they're infusing capital into the business, it's for 15%, 20%, sometimes larger stakes, but they're not in the business of running the company that they're putting money into. In the case of companies like Mensa Brands, they identify promising companies and acquire at least a 51% stake in the business. And then they leverage their team and technology to try and scale the business as quickly as possible. In a nutshell, what they're trying to do is to try and create the new age brands that are out there, specifically across three segments. One is fashion, the second is home and decor, and the third is beauty and FMCG. One of the key hypotheses that this business is built on is that as India grows as an economy, these segments itself will grow, and a lot of their brands will take on pole positions in these segments.
Got it. The macro story makes sense, but in terms of structure, this sounds more like a private equity play than a investment venture capital play. So I guess my question is it a primarily financial play? Are there deeper integrations? Are there synergies between these brands that makes the sum greater than the individual parts? And also, if I may add one last thing, you're removing the founders, I presume, because you're disincentivizing the operators in here. So yeah, just tell me more about what exactly
Yeah,
is this acquisition.
so great question. I actually think it is a lot more like a private equity play. And while the company may not brand itself as a private equity company and they'll want to brand itself as a technology company, I think it is a private equity company masquerading as this new age house of brands technology company. That's my take on the situation. Um, that being said, though, these are the four big things that Mensa brings to the table for any of the companies that is acquired. Right? Firstly, it's tech. They have created platforms for pricing, ads, etc., which will be valuable for companies as they scale. Secondly, it's on the admin and operational side of the business. Everything from warehousing to logistics to sourcing. There will be some level of economies of scale, at least between brands within a particular segment, right? For example, if a fashion brand were to source their materials from the Vardamans or Arvind, they're likely to get better prices if they're going via Mensa versus going directly because Mensa is acquiring all these material across their entire set of SKUs for all their fashion brands, right? Thirdly, the big thing that they end up offering, and this really is a differentiator, it's around the team and expertise, right? So D2C brands, as with any other kind of companies, the first $1.5 million that they bring in is driven by the founders and the hustle of the founders. there's a unique need they find in the market, and they really work extremely hard to actually end up making that happen. But as a company scales, it's super important to get a different level of talent and expertise into any business, right? And that's actually true for D2C companies as well. But a D2C brand that is operating by itself is unlikely to be able to attract this caliber of talent, right? They just won't really get the level of scale that would actually justify even paying the amount of money that this talent would require. So that's something that Mensa has been able to do, and they will be able to deploy the talent arm across their entire portfolio of companies, which is valuable. And lastly, the other thing that Mensa has done, and this is again quite unique, is that they've actually invested quite heavily around content and community. They acquired this men's community called Men's XP, and they acquired this women's community called iDiva. Between both these different platforms, they're able to generate close to 90 billion unique impressions every month, which is quite significant, right? And both these platforms are leveraged as this horizontal content and community arm for all their businesses. The other thing that they've actually, in my opinion, done a smart job outside looking in is they've also acquired this influencer management company called Hip, right? Who's in the business of actually managing influencer relationships and dealing with all of that. So they've actually gone ahead and made that investment as well, because the world is quickly moving into just buying from people rather than buying from brands, and they're trying to position themselves accordingly as well. The last thing that you actually asked about, Govind, is hey, they're like buying out the founders over here. Are they actually incentivized to continue to work on the business? So this is actually something I did look at least according to LinkedIn, the founders of a lot of their brands are continuing to stay with their brands. So the Dennis Lingo founder, he's continuing to stay with Dennis Lingo, even though it's been acquired by Mensa. Same thing with My Fitness. So yeah, that is something that is, at least for their successful brands, that they have managed to be able to do. And yeah, at the end of the day, even if Mensa has acquired a 51% stake, the founders still own a significant chunk of the business, and they are incentivized to actually see it grow. And now they have the necessary capital and talent resources to actually make that happen.
And I imagine the acquisition price is also based on some sort of vesting schedule and
Yeah,
some sort of performance-based compensation. So they may have got those incentives in order. Let me work through the 4 points you said, right? So we kind of touched on team towards the end, which makes sense. If you, especially if you have the core team and then you amp them up with like other management, perhaps something can be done with this. I mean, the tech question, I'm like, I'm shaking my head up and down a
I'm
little bit because
skeptical
there's
as
so
well
many of
about
these.
that. Yeah.
Yeah, yeah, because there's all these SaaS tools and the ads tools are very good, but I guess there is a certain quality bar that needs to be met. So you can maybe, so it seems like a weakish argument. I can totally see the operational side of things, right? Warehousing, logistics, and so on. Again, there are outsourcing options, but that's a pure margin improvement game, unless the quality of the material you procure is more and so on. But it sounds like this is a pricing thing more than anything else. So that's a margin question, and I can see how that's very private equity, but doesn't make so much sense in terms of it makes more sense if the brand is bigger. So I guess one follow-up question there is, when these companies are acquired, and we'll probably dig into this later in this conversation as well, what is the stage at which these companies are at revenue-wise and progress-wise?
So, good question there. The different companies are at different scales when they get acquired. But one of the things that at least Anand Narayanan, the CEO, has said is that they only end up acquiring EBITDA positive businesses. And reading between the lines in terms of where some of these businesses were when they were acquired. So, if you look at companies like Dennis Lingo, they were making around 30 to 35 crores in revenue when Men's ended up acquiring them. So, there was definitely more than enough proof to show that there was demand for their products when Mensa ended up acquiring them. So, long story short, they're not acquiring these businesses in the 0 to 1 stage, but rather in the 1 to 10 sort of stage.
That makes sense. The last bit that you mentioned in terms of the advantages that Mensa adds to the mix, which is distribution and cross promotion, is quite interesting because when I think of stages of company growth, I immediately go to these charts which say early adopters and like passionate micro niches, and then over time a business has to move from the people who really love it to the average population. So I imagine that a lot of these folks have micro communities to with which they built up as like loyalty customers or to whom they have direct distribution. But at some point, that quirky jumper needs to go mainstream, and at that point, that audience is quite common across all of these brands. So at a surface level, that makes a lot of sense, and that feels like the most powerful.
Yeah, they need to cross the chasm. So I don't think a lot of these companies have crossed the chasm yet, but they do have the potential to cross the chasm. The other thing to actually call out over here, like you hit the nail on the head, right? Who are those micro communities that are actually buying from these companies? That's very important to any acquirer, and especially Mensa. They look at things like repeat rates for orders, along with like the ratings across various platforms and so on and so forth, along with what is the channel mix. Is the entrepreneur just pumping in a lot of ad money to actually end up getting more customers? All of those things actually end up going into making a decision on whether to buy the D2C brand or not. So, yeah, just something I wanted to add there.
Correct. All right, so let's look at it from the weekend entrepreneur's perspective, right? The founder, Anand, how did he do this? How did he raise? This doesn't seem very weekend entrepreneur. He feels like he would have gone out and raised a lot of money from the get go to be able to do this. How was he able to do this?
Yeah. So, Anand Narayanan, the founder and CEO of Myntra, was the former CEO of both Myntra as well as MedLife. And prior to that, he was a partner at McKinsey for decades. He's a phenomenal storyteller. I've listened to a bunch of his podcasts. I think he's really quite phenomenal. And beyond being a really good storyteller, he also brings a certain level of expertise and pedigree that investors would be willing to back, right? The other thing to keep in mind here is that Mensa was started in 2021, which was in the midst of the pandemic. So that was a time when online commerce was going through the roof, and there was a lot of interest from VCs in these roll up companies. There were plenty of other companies like Thrasio in the US or Razor Group in Germany, all of whom who raised significant amount of capital around that time, right? Mensa, in a lot of ways, was just replicating the same model in India. And to be clear, Mensa is not the only company in India doing this thing. There's also Goat Brand Labs, and there's also Global Bees. Um, so a lot of those things actually came together, which allowed them to raise this extremely large amount of capital at an extremely high valuation. Huge props to Anand for making this happen. Raising this much capital at this valuation is not easy, right? It requires a certain caliber of an entrepreneur to actually end up making this happen.
Got it. So, not the kind of business that the average weekend entrepreneur would consider starting. But let me tease apart the underlying force that allows for a company like Mensa Brands to exist, which is the rise of D2C brands, the larger macro story that you brought up at the start, which implies that India's markets are growing and there's opportunity for businesses to come up. So my structural question here is, why are there so many D2C brands coming up right now of all times in the last 20 to 30 years? What's changed?
Yeah. So great question. There definitely is an explosion in D2C brands that are out there. Um, and I think to unbottle why that's happening, I think it's worth thinking about what has actually changed in India, right? So let's talk about vintage brands in India. On the FMCG side, they're mostly controlled by the Unilevers and Daburs of the world. They built a ginormous moat by working with various distribution partners and getting shelf space across 2 million plus Kirana stores all over the country. If you think about fashion, you have the Raymonds, the Fab Indias, the Peter Englands that people usually purchase from. They were not to set up their exclusive brand outlets pan India to get to scale. However, these distribution channels that they built are no longer moats. You can get to 20,000 plus pin codes in India within 2 days by spending anywhere from 120 to 130 rupees, right? And this may become even faster in with quick commerce. So D2C brands all of a sudden could end up selling pan India because the distribution moats no longer existed. These new age brands could reach the same set of customers that these vintage brands have access to without actually building their own distribution channels. So, since the moat no longer exists, more and more D2C entrepreneurs are able to venture out and get to some level of scale. So, that to me is one big change that has happened in India, which is enabling more and more D2C companies to crop up. The second big change that's happened is with regards to how consumers' buying patterns are changing. Even now, e-commerce only accounts for only 8 to 12% of the overall retail revenue, and that number will grow. But the thing that has changed, though, is that how consumers do research is happening online, even if they choose to actually buy offline. So the newer age entrepreneurs understand this and are digitally native and are exploiting this advantage to get in front of potential customers. So those are two big things that I think has changed, uh, which is leading to the explosion of D2C companies in India.
Understood. Um, that makes sense, and I buy your argument in terms of the in terms of why D2C brands have an entry. But I will push back on one thing, which is, does the moat for these vintage brands no longer exist? And a very topical article that's been going around on LinkedIn in the last few days is this article on the epic saga of value destruction of Nike. I think circa 2020, the new CEO of Nike made a push for Nike to be an entirely D2C company, and then they landed up breaking down a lot of their traditional brick and mortar partnerships and advantages and so on, and their stock price is suffering for it. Now, this is a theory on LinkedIn, but I guess one thing we can put a pin on is the jury is out on whether D2C is going to sort of be this wave that sweeps up all of brick and mortar, or is it just another sort of distribution channel that's now created a lot of these entrants? And will these entrants eventually have to expand to a brick and mortar setup, which to me is also interesting from a Mensa perspective, because it's hard for, I mean, your average D2C entrepreneur, I imagine, is really great at marketing, and most of the on the ground logistics stuff is not where their forte is. But a company that rolls all of this up could build out a lot of this infrastructure if, in fact, you want to say, hey, let me set up the store where all of a sudden I have like my, I have my Dennis Lingo and all of these companies distributed in one shot. So I'm thinking on the spot, but that could be an interesting additional value add that a roll up like this can bring to the table.
Yeah, and to be perfectly clear, I think that is important in India once you actually get to a particular scale. So, at least according to Anand, his view is that once a brand actually gets to 1,000 crores, it is important to have like a physical offline presence to actually end up scaling the brand even further, right? And even before that, some of their Dennis Lingo, they've actually opened an outlet in Mumbai, right? Where people can actually go in physically and shop for things. So I don't think offline is going away, but you end up investing in offline after you get to a particular scale and after you've managed to prove demand to a certain extent. The other thing to actually note here when it comes to offline versus online is the fact that um, price point really makes a huge difference. If you're selling something in the 1,000 rupee, 1,500 rupee price point, that's going to be something people feel comfortable buying online, which is why a lot of these fashion brands operate in that kind of a price point. But if something is going to cost you 10,000 rupees or 15,000 rupees, you almost need to be able to physically touch wear those things before you end up making that purchase. So I'm by no means saying that offline and physical retail stores will completely go away. I'm just saying that this is a good way to enter the market, really prove out demand, get to a certain level of scale before you actually go on to make other investments. And by the way, Govind, I actually liked one of the ideas you put out there. So Dennis Lingo, for example, has a physical outlet Dennis Lingo store, but can Mensa really be the new age West Side where all their brands, they actually have a Mensa outlet with all their brands in there? I'm not sure. It doesn't exist right now, but there may be a case to be made to actually make that happen as well in the future.
Yeah, what's funny is a lot of retailers try to build their own in-store brands. So retailers try to move downstream and become brands, and they have mixed success. And often it's done. I've seen it as a consumer work when things are cheaper. So you build a house brand that's much cheaper than your incumbents. This seems like a case where a brand could become a retailer, especially as it doesn't just spin up new brands, but it acquires other brands. So I'm sure there's a lot we'll see here. But let me take a step back here. I'm trying to understand, does Mensa as a company make sense? And I have this at two levels, right? Number one, how many are there a lot of brands that have synergies? We've talked about fashion and we've talked about FMCG. What are the synergies between the two, or are these just considered like independent verticals within this common Mensa category? And is there more thought put into what subcategories they've chosen to make acquisitions within? And my broader question is like financially, do we have any proof on whether this makes sense? Because you mentioned Thrasio earlier. For a lot of us following the news, these roll-ups seem to be this new concept that just haven't picked up in the rest of the world. So what's different here, and why would this company succeed?
Yeah. So the concept of Mensa or a roll-up brand of various different companies is not exactly new. There are plenty of companies like this across various segments. I was reading about this company called Madura Fashion and Lifestyle, which bought brands like Louis Philippe, Alan Solly, Peter England, etc. They themselves then got bought out by Aditya Birla Fashion and Lifestyle, and went on to build many, many different exclusive brand outlets and struck deals with various distribution partners. Very old school vintage business, but they're essentially doing what Mensa is doing there. Um, and this also exists across the world. There's this billion-dollar publicly traded company in the UK called the Hut Group or THG, which also does the exact same thing. What is interesting about Mensa, though, is that they bought companies across various verticals. So they didn't just buy fashion companies, they didn't just buy FMCG brands. And while I do believe that there could be a lot of synergies that exist between companies within a segment, aka companies within fashion, the jury's still out on whether there's actually synergies between a fashion brand and an FMCG brand like MyFitness. I'm not able to see it yet. Yes, you will be able to amortize cost in terms of admin work like legal, HR, etc., etc. But I don't see too much more beyond that, I guess.
And what happened with Thrasio specifically, by the way?
Yeah, so Thrasio, good question there. Thrasio was the poster child for these roll up brands, and they recently ended up filing for Chapter 11 bankruptcy in the US. And when you hear the word bankruptcy, it's a really scary word, and you would think in your head, oh, this company shut down. But the reality is that in the US, if you file for Chapter 11 bankruptcy, what it essentially gives you is protection from debtors, and it gives you the option to reorganize your debts and attempt to regain profitability while under the protection of the bankruptcy code. So they're still very much in business. They're just trying to reorganize the business to get to profitability. That's how I see it. And the important thing to call out here is that you can definitely make the case Thrasio raised way too much capital and they're not able to live up to that valuation. 100% agree there. That said, a lot of the businesses that they did end up buying and the brands that they did end up incubating and growing does have value, right? Just not as much value as they had in the past. So those brands do have value, but as an entity, they're just not able to live up to the valuation that they were able to get to in the past.
Understood. So there is valuation, which is in a way a bench. I mean, it's a problem that investors have to deal with, and in a way a benchmark of how big the company can get. But there's also for this kind of company the question of how much you've paid to acquire each of your individual brands. So bring it back to Mensa. Do we have a sense of roughly how much they pay, or more broadly, do we know if their bets have paid off? Have their brands grown post acquisition? What does the portfolio look like right now compared to when they were acquired? And when were these acquisitions made, by the way, roughly?
So Mensa was incorporated in 2021. They ended up acquiring a bunch of companies in December of 2021. Again, a few in 2022. So they have around 20-ish sort of brands that they've acquired at this point, and it was over the course of the last 3-4 years.
And do we know what sort of revenue they're making? How well these individual brands have done? Have all of them worked out? I imagine some will fail, right?
Yeah. So The way I look at it is, at the end of the day, think about the word brand, right? How would you even measure if a brand is actually growing? I look at it in terms of, is the brand able to grow organic traffic? Are people actually searching for that brand? And when I was looking at that across the portfolio brands that Mensa actually has, there are brands like Dennis Lingo where they were able to see an organic traffic growth of over 3x since the Mensa acquisition. The same thing with Pebble, which is an electronics company, right? And Anand has been quoted with saying that Dennis Lingo was between 30 to 35 crores when they acquired the business, and now they're operating at approximately 130 to 140 crores. So there have been certain successes, right? Um, but there are companies that haven't lived up to the promise as well. And the company's plan is to actually roll up these other brands and SKUs and so on and so forth to their better performing brands within their portfolio. So, long story short, there are around 7 companies that are making over 100 crores in revenue. There are probably another 7 companies that have the potential to make over 100 crores in revenue. And the ones that didn't end up panning out, their products are essentially going to get rolled up and merged into the brands that are actually doing well. So that's basically what Anand has said in terms of how Mensa is doing as a business. That being said, he's a founder talking in a public forum. So we do need to take everything that people say with a grain of salt. But outside looking in, when I'm looking at search traffic and organic search traffic, several of their brands have actually grown in terms of organic reach, which is huge.
So let's bring this back to valuation then. Do you think, uh, especially because we started this with the Thrasio conversation, do you think Mensa is worth the valuation that it commands, and how big do you think it could be? I guess that's the more interesting question to ask here.
Yeah. So I'm not 100% sure of the current valuation of Mensa. Anand was able to raise a significant amount of capital and get to a valuation of $1 billion within 6 months of incorporating the business. That said, there have been subsequent equity rounds, and I'm not 100% sure of what the company was valued at each and every one of those rounds. But for the sake of this exercise, let's assume that it's still valued at $1 billion, right? And how I look at whether a company can live up to its valuation or not is by looking at larger company comps and especially public company comps. Um, and the company that I'd like to take as a comp over here would probably be Aditya Birla Fashion and Lifestyle, which is valued at around $3.86 billion, right? And they're making around $1.66 billion to get to that valuation. So approximately 1,400 crores in INR. So they're able to command a price to earnings ratio of around 2.3x. At a $1 billion valuation, to justify that valuation, you need to make around $434 million or around 3,600 crores, right? I don't think all their brands put together are making that kind of money yet. That being said, you can also end up making the case for, hey, these brands are a lot more faster growing, are we don't have exclusive brand outlets, our margins are better because of that, etc., etc. So you can potentially get a better multiple over there. um, but you will almost need like a 25x multiple, 30x multiple in order to end up justifying that valuation, which, certain VCs may be willing to actually, even now, provide that. So, yeah, that's basically how I would um, think about their company. I think the business definitely does have value. Do I think it's valued at $1 billion? Well, it doesn't really matter whether I think it's valued $1 billion or not. Um, that's what other people out there with money are willing to value the company at.
On the 2.3x revenue, let me sort of double click on that. Right, 2.3x revenue for Aditya Birla Fashion, which is a more conventional, as you brought, as you stated earlier, vintage brand or vintage old school company. Do you have any idea if the earnings, the margins for D2C centric companies are higher or could be higher in the long run, therefore necessitating a smaller multiple? Because what we're looking for at the end of the day is earnings, right?
Yep. A long story short, yes. And the reason why DTC brands typically have better margins is because, or rather, Well-run D2C brands could theoretically have better margins because you don't have to deal with a lot of the physical infrastructure and pay the distribution fees and so on and so forth to actually get your product out into the hands of consumers, right? Eventually, when you get to your own exclusive brand outlets and so on, you may need to end up doing that. But DTC brands theoretically could end up having better margins that way. And the other thing to keep in mind is DTC brands may be better at estimating demand for their product, right? Versus other traditional brands, they may just need to end up mass manufacturing a whole bunch of product, and it may just be sitting around for a longer time, right? So those are certain advantages that D2C brands have over these vintage brands that are out there.
Understood. And I think some of this will come down to the marketing channels as well, right? As long as they don't rely a lot on brand marketing, performance marketing, if
Yeah,
they can get the organic story growing, then the cost on that would
that's
be
the
low.
big thing. That's the big thing. And that's where, like, I really think it's important that companies early on, not just in D2C, but they really focus on community. They really focus on grassroots level marketing to actually um, propel their growth even several years and decades down the line.
Yeah, makes sense.
One thing I wanted to add here, actually, Goen. So I may have sounded a little skeptical about Mensa's valuation, but there's a lot to actually like about their business. One is it's really sitting on top of the India growth story, and I'm very bullish on the India growth story. So as India grows as an economy, I am bullish on companies like Mensa as well growing and being able to capture a significant amount of value. The other thing that is interesting about this business is they're actually owning various assets. If at a certain point they need to raise capital, there may even be an opportunity for them to sell off one of their brands and infuse a lot of capital into the business, right? That is something that a lot of businesses don't necessarily have, which is something Mensa has, which I really, really like about the business. You know,
Understood. I get the positive side, and to be clear, I don't think you came off as super skeptical. I think that was a fair assessment. But my question was going to be, if you were a bear on this business, what do you see as risks for the company?
yeah. The first big thing is lack of focus. I'm not entirely convinced about the synergies that exist between a peanut butter brand and a fashion line. That said, diversity of the business lines may actually help them in the long run. The second big risk that we alluded to earlier itself is around living up to the valuation. They raised their big round when there was an enormous amount of hype around D2C, and they were consequently able to command a really good price for the company. And now it's time to actually start showing results. I'm not sure if they're going to be able to do that or not. But that being said, I would do the exact same thing Anand did, because the most important part about this business is capital. And being able to raise a significant amount of capital while diluting as little of the company as possible is important for this business, right? So I don't want to call it a risk, but they need to live up to that valuation. That is going to be something that is important. And then the third big risk I see for Mensa is purely based on the market that they're actually operating in. None of these are winner takes all markets, and consumer preferences will change over time. And it's also becoming easier than ever to get distribution on a brand that anyone is building. So there's always a risk of someone else coming up and taking a significant share of the wallet of the same set of consumers that some of the Mensa brands are actually going after. So that's definitely a risk. There's a big push around influencer led brands and them actually pushing their product to their audience. So, yeah, those are really the three big risks that I would say for Mensa as a business. That said, all companies have some level of risk. This is what I think their risks are.
Okay, so let me get you off the fence then. Are you a buyer or seller of this company?
Depends on the price. Would I buy it at $1 billion? Probably not. There's probably not much upside for me over there. Uh, but at a more reasonable, and I don't have access to their financials. Everything that I spoke to you about is based on listening to various podcasts and reading a bunch of different blogs and so on and so forth. So I don't have access to their actual financials. Long story short, I do think a business like this does need to exist. Put in my money at $1 billion valuation? Probably not, because I think there are other opportunities out there where I would rather put my money into. Um, but yeah, there is room in the world for businesses like this.
Yeah, personally, I mean, if I would ask myself the same question, I believe strongly in this notion of like founder market fit, or more generally, like, career or intelligence market fit. And a lot of the things that you're saying are intellectually stimulating, but this seems like a logistics and finance centric play. And I know what my lane is, which is I find it far more easy to I feel like I have a greater advantage, or greater opportunity to detect alpha in companies that have a more technology led growth story, which squarely puts this in the realm of companies that I would rather just sort of keep my money out of due to sheer ignorance. But this also does give me a lot of interesting ideas in terms of the kinds of business models. There's two takeaways I have here. Number one, what are the kinds of business models one can engage in, not just in D2C brands, but in say our industry more generally, right? Software. When it comes to software, entrepreneurs building in software typically have one or two standard models we look at. We try and build software and we sell it as a service. So we have SaaS, or we build some sort of vertical software integrated system where software brings in the efficiency, and that's it. And off late, the conversation has introduced things like compound startups into the mix that are extensions of some of these business models. But I do wonder, what does the finance play look like when you combine it in something like a software space? The one company that this reminds me of, actually two things that this reminds me of very topically. Number one, in the All In podcast, Chamath keeps talking about his 1890 accelerator, which is basically, I mean, I don't know how serious he is about it, but it's basically an attempt to build this sort of constellation of small software businesses from 0 to 1, not acquired, under the understanding that moats in software aren't very strong, and you can build a lot of these companies quite rapidly and kill the incumbents, with the assumption that the distribution element is solved, which you can argue is just as true in software as it is in D2C brands, because the buyers are often the same enterprises that you would sell to. When you're selling a Slack, you could also go ahead and sell a Microsoft Office, and you could also go ahead and sell a Notion, because all three are the same customers, and upselling is easy enough. I also use the word constellation because when I knew that we were going to chat about Mensa Brands, I looked up this company called Constellation Software, which completely blew my mind, but is worth about 60 to 70 billion US dollars, and has been doing this for the last 30 years, where they almost to a fault value companies according to a very strict set of financial parameters, with their argument being that acquiring tons and tons of like these small niche tech companies can result in a very valuable whole, and they're a public company, so the market seems to agree with them. So yeah, lots of interesting learnings here, which I think is more broadly useful for us as an exercise, because we tend to look at our industries through a narrow lens, but when you broaden your horizon, you learn all of these other approaches and models.
Yeah. And what you spoke about roll-up companies and these software companies, or are these roll-up companies that focus on software that exist across industries. So there's this company called Eat Fit that started by Ankit Nagori that does a roll-up of restaurants, and I'm sure it exists in healthcare and every other segment out there. The software part of it is interesting. I hadn't heard about Constellation Software until you shared that with me, but there are other companies like Tiny, started by Andrew Wilkinson, that ends up acquiring a significant stake in various different businesses, and that's worth over like several $billion. So, in a lot of ways, it makes sense. But the one underlying theme for every single one of these companies is capital. You either need to have made a lot of capital, or you need to be able to have raised a lot of capital to actually go on to end up acquiring these businesses. That's the most important part if you wanted to start a roll up business in whichever vertical.
Right. And if you flip things around, I think you can also look at it as, what are the opportunities for folks who run profitable businesses? I think you mentioned that Mensa only acquires companies that are a bit positive, if
Yep.
I'm not mistaken, right? So this tells me a bit about what kinds of businesses that want to run. The standard mold for most people who are probably listening to this video is, let me raise a bunch of VC capital and try to improve my valuation, and then VC funding is the sort of massive first step that will allow me to like get to the second step, and then get on this factory line, as Sam Lesson would say, of Series A, Series B, and then build these giant businesses. And the idea there is also that we can get to these giant acquisitions and aim for public company exits and so on. But companies like this, these roll-ups also to me represent an opportunity for people who run a more tight ship and even go after like smaller niches or what appear to be smaller niches at first without having to worry about will the TAM sort of tap out. With the knowledge that perhaps there is a legitimate exit on the horizon. In fact, I wonder if this might be too contrived, but could you sort of work backwards to see what the India macro story would be, which would cause a roll-up company, be it in D2C brands or for that matter, even in software, to want to acquire a specific type of company, and you position yourself as the person who's discovered that niche and can win that niche, and as a result, you have a new exit option. So
Yeah, so great question there. I agree with you with how you said, with the overall premise about there are certain founders that may not be able to raise a lot of venture capital, but they're running their business. But to what end? After like spending years, decades even, they want to end up doing something else, but they also don't want the business to die. So what would they do with it? There are founders that end up stepping into like an executive chairman role and then hiring a CEO to run the business. That's a model that I've seen. But I do think these roll up companies will end up playing an important role in the overall ecosystem in terms of acquiring the good businesses here and figuring out a way to grow it even further. From my vantage point, one of the things that I keep seeing are tons and tons and tons of SaaS companies, right? And how many of these SaaS companies can really end up going public? They will need to get acquired at a certain point, right? And when you're looking at buyers from an acquisition perspective, sure, you ideally you want to get a strategic acquisition going because you're likely going to end up getting a much better multiple there if you're able to make that happen. But if you're not able to do that and you've raised very little capital, you have this sort of option to go on to sell to one of these roll up companies and make a decent amount of money. And this may be something for another video, but liquidation preferences that they really kick in based on the amount of money that you've actually raised. So someone who hasn't raised a lot of money at the time of exit may end up actually making a lot more money than a similar, I don't want to say, than another founder who's actually raised an enormous amount of capital for the business. So, but anyway, that's topic for another episode.
I definitely want to do an episode on looking at what a business like this might look like. We haven't done any of these speculative businesses from scratch debating sort of conversation. Um, but I would definitely like to do one on software roll-ups because I think we agree on a few things, right? Software is not necessarily a winner-takes-all market. The assumption of 2013 is not true in 2024. I think supply side, there are a lot of engineers, so the ability to build software cheaply, especially also because there are all these open source abstractions and cloud provisions and AI and all of this good stuff that allows you to build large software businesses cheap, has become a phenomenon. And there's a lot of VC funding because every VC goes in with the assumption that a software company that has $1 million in revenue has a direct path to making $100 million of revenue. So it does feel to me like, as we even have this conversation, there is this ripe ground of acquirable companies, tiny markets, advantages of distribution, because we keep talking about how software is increasingly about distribution and not the actual generation of the writing of the code and the creation of the product. So perhaps we'll do an episode just on this next time around.
Yeah, I think that'd be fun.
Awesome. Well, thank you, Rohit. Thanks for introducing us to Mensa Brands. I definitely think these alternative perspectives on new kinds of businesses help, no matter which industry you're in, just so that you can marry ideas from different points of view. If any viewers out there like this video, please let us know in the comment section. And if you just like the content in general, please like, share, and subscribe. Looking forward to seeing you in the next episode of Weekend Entrepreneurs.